Welcome to the HC Commodities Podcast, a podcast dedicated to the commodities sector and the people within it. I'm your host, Paul Chapman. This podcast is produced by HC Group, a global search firm dedicated to the commodities sector. Today we are talking hedging. Who does it? Why do they do it? What are some of the risks and costs? And why aren't enough people doing it in such a volatile commodity market? And how will that change in the future? Our guest is Samuel Basi, author of Perfectly Hedged, a practical guide to base metals, and founder of Perfectly Hedged LLC, a consulting company delivering in-person learning courses in and around hedging. Samuel spent 15 years as a lead and zinc trader at Trafigura and was latterly head of derivatives at Greenwich Metals. As always, you can really support the show by leaving a positive review on the platform you're listening on. And as always, I hope you enjoy the episode. Samuel, welcome to the show.
Thanks, Paul. It's great to be here.
We're talking together. In front of me, I've got a copy of your book, Perfectly Hedged, a practical guide to base metals. And we'll finish up on that book and the goals and objectives on it. But today we're talking hedging. What is it? When is it used? What are the risks? Who needs to do it? And there's a lot of big story here as the markets have become more volatile. But let's sort of start at the very beginning on the understanding that many in our audience will know exactly what we mean by this. But what is hedging? What are the sort of the basics of it and the objectives around it?
Yeah, sure. So hedging itself, the main objective is to make oneself price agnostic. So what that means is not that we, as traders don't care about the price of a commodity, but that when you hedge correctly, your profitability will not be impacted by, any subsequent movements in the price of the underlying commodity. Most of the time to hedge, you enter into a futures contract that is equal and opposite to the direction of the physical trade itself.
Right. So if you're buying X million tons of oil, crude oil, you're at the same time selling futures for that same equivalent tonnage.
Exactly. Same tonnage and same price for all intents and purposes.
Obviously, different organizations have different objectives around this. Can you give us sort of some sense of how this actually operates in a particular market and who's hedging and so forth?
Yeah, sure. So, if you look at metals, for example, everyone from miners to traders to producers all the way through to end consumers do often some form of hedging. Traders will often assume a perfect hedge because they don't want to take any price risk on their physical business. They obviously may have derivatives desks that do take price risk, but their physical traders want to offset 100% of that price risk. And miners may enter into some hedging to lock in a forward margin. Same thing with consumers, but it really is used across the broad spectrum of the commodity industry.
Yeah. It's funny that hedge funds are called hedge funds, right? I know the historical background of that, but obviously they're all designed about taking risks. Okay, yeah. There's some sort of myths and strange artifacts that come from this, right? And that's often because we don't necessarily see all of the picture of what's going on. And this was particularly prevalent in, say, a couple of years ago with really, massive price spikes in nickel and in natural gas and so forth, when you were assuming that a side could have made huge losses on the physical positions. But obviously what we don't necessarily see is their hedges on the other side that net those out. Can you give us some sense of kind of the visibility of this and how we can see and understand these operations in the actual market?
Yeah, sure. So, as you say, most companies that do enter hedges, you're either going to take a loss on the physical trade. Let's say you buy copper at $9,000 a ton, and by the time you sell that physical parcel, the price for your customer has dropped to $8,000 a ton. But at the same time, you will have sold copper futures at that same $9,000 a ton. And when you sell your physical, you're going to be buying back those futures at the lower price of $8,000 a ton. So where the physical trade is losing $1,000 a ton in this example, your derivatives trade is going to gain $1,000 a ton. That's going to offset any loss on the physical. So we often don't see those inner workings of companies, but the fact that traders and those businesses survive in the long run means that they are hedging, because you just cannot survive in the long run, especially with the volatility you mentioned, just expecting that you can buy a commodity and the price is going to be higher in the future, or vice versa. If you're selling a physical commodity, the price is going to be lower by the time you sell it.
Yeah, and if you're one of those physical players or one of those trading houses, who sits on the other side of that hedge? Who's providing that liquidity to you?
So it depends on the company. Some larger traders will have internal brokerages where their own derivatives traders will provide that liquidity to the physical desk. But for the most part, it's brokerages on the LME, the CME, the SHFE that are providing that liquidity to essentially anyone who wants to hedge their price risk on those various exchanges. So those brokerages, various categories, for example, on the LME, have the ability to provide that hedging facility to those companies.
And then the trajectory since the global financial crisis has been more and more of these contracts on exchanges. And they're getting more granular in terms of the nature and types of those contracts that are there, but also, I guess, removing the need to go to the OTC markets where you're doing a bilateral trade. Can you just give us some sense of A, is that correct? And B, what is the dynamic there? Is this meant that hedging has become more democratized before we go on to who is and who isn't doing it?
Yeah, sure. I mean, we've definitely seen a move towards, especially with the EV movements, those battery metals, various exchanges trying to launch those products, whereby, as you say, you can do a cleared trade, not necessarily OTC. And they're having a decent amount of success with it, as we enter these increasingly volatile times, whether it be from geopolitical risk or just outright supply demand risk. The prices are reacting accordingly, and so more and more participants in those markets are looking to mitigate those price risks, and obviously the exchanges are stepping up themselves to offer those facilities to do so.
If you look at the last decade, it was a period of relatively low volatility across the commodities suite. And then starting with just before actually COVID, but COVID accelerated it, and then Russia's invasion of Ukraine put it on steroids. You've had really high volatility, and it was kind of surprising in that some organizations that clearly hadn't hedged themselves. I think of particularly European utilities, real participants in the market that had not done this basic risk management. And I guess this is where I really want to lean in on kind of like who wasn't doing that? Why was that surprising? And indeed, why weren't they doing it?
Yeah, I mean, honestly, in some cases, it's actually less surprising to me because I've been in the industry so long and have seen that, for whatever reasons, some people are just not taking advantage of these opportunities. We're very lucky in that a lot of these commodities have these very liquid exchanges whereby you can mitigate through hedging almost the entirety of your price risk. However, there are various industries that they just haven't adapted and either don't have the knowledge of how to, or just simply don't want to hedge their price exposure. Sometimes, a producer may want to have the upside to price rises, or consumer may want to not hedge so that they can capture any downside to the price. But the risk is always that we don't know where these prices are going to go, and so the most prudent thing for a commodity participant is to hedge that price risk. And we saw throughout the last few years some participants take heavy losses because they either didn't hedge, or they didn't have those programs fully developed, or just hedging incorrectly. And so when you don't have the knowledge, you don't have the correct people in place, you leave yourself exposed to those price spikes, to those price dips, and your profits can go along with that.
Yeah, and probably decisions have changed quite rapidly in the last couple of years. And yes, there have been all these much vaunted producers that want their shareholders want exposure to the price, and therefore they don't hedge. That definitely seems to be
Yeah.
changing. Let's say you look back and you're sort of like, I wish we had hedged. What at the most basic level do you need to be, if you're the purchasing department or sales, or whatever it might be, to actually be able to execute a hedge? Like, what functions, what capabilities at its most basic level do you need?
Yeah, I mean it's relatively simple, which I think is one of the misconceptions that hedging is this extremely complicated subject that you need all of this infrastructure to be able to handle. You really don't. You need a couple of people internally who can manage these positions and actually execute the trades, and you need to have an agreement with a broker on the exchange you wish to trade on to actually execute through. But outside of that, you really don't need too much, and I think we can get on to later some of the risks, when it comes to margin calls and the cost of hedging. But in order to actually set up a hedging program, the barriers to entry are relatively low.
Yeah, and just specifically, what are those two people? How are they typically structured? What roles are they actually doing?
They will be actually physically executing the hedges with the brokers themselves. So they'll be taking the orders internally from traders or operators, however it's set up in the company. And then they'll be, managing those positions once the hedges have been executed. A big part of hedging is position management. So, after that initial hedge has been executed, managing that, making sure that everything is lined up internally. But it's not a complex thing to understand, but it's something you have to understand, the basics of very well to make sure that you're not making those errors.
And is this a knowledge gap? I'm just sort of thinking back to my MBA. I mean, we did a little bit of this, but it's not. It doesn't seem like this is sort of your average CFO who, in any manufacturing company, is heavily exposed to commodity prices. How? I guess I'm just trying to understand. Like, is the vast majority of the Fortune 100 or the, whatever, FTSE 100 or the S&P 500, are they, do they have hedging operations, or is this still sort of somewhat of an arcane discipline that is,
Unfortunately, I would say that it's from my experience, it's a large part of it is kind of learn on the job. There's no kind of dedicated hedging programs. Part of the reason why I set up Perfectly Hedged was because I really did see that knowledge gap. I'd taught this kind of subject for the best part of the last decade, in these various roles that I've had, and there really isn't much specific literature that's applicable, many programs that you can go on. And as you mentioned, not many people internally at these companies who either have the knowledge or a lot of the time have the time to actually sit with people and explain these concepts to them. So it does appear to be something that kind of just gets left by the wayside, or there are very specific people in those companies that do hold that knowledge, but every facet of commodity trading has some exposure to hedging. And so in my opinion, anyone who sits in a trading firm, at a producer, a miner, a consumer, or even a bank to an extent, who are financing these trades, really needs to have some base level knowledge of hedging to avoid making those simple mistakes, and importantly, to be able to capitalize on those opportunities for additional profits.
it's interesting, isn't it? Because there's also kind of, I don't know, it's the nature of the 10Ks and so forth, 10Qs, like, the losses to derivatives, right? It's, it has its own section
Yeah.
and always looks enormous, but it does take a bit of unpacking and sophistication on the analyst front, and shareholders and so forth, to figure out that that's not an outright loss. I just,
Yeah.
I'm sort of leaning into this idea that there is sort of it's a bit of a dirty word and a bit of a negative perception around it.
Yeah, I mean, I've worked on the physical side with people who look at the LME as some kind of dark magic that just kind of they don't fully understand it, and as you say, they don't know how to explain that a derivatives loss is not actually a loss because it was offset by a physical gain to their shareholders. I mean, unfortunately, a large part of this is in the explanation of what you're doing rather than the actual setting up and execution of it.
Yeah, and we're going to come. I guess we're talking essentially about why this is going to become an even more crucial function in predictions around volatility across the supply chain are going to hold true, and I therefore be higher and more spiky more often. But it's not a perfect world, right? There are costs and there are compromises to hedging, and the first one of those is really about, obviously, there are only a certain suite of commodities that have a perfect hedge available, i.e., there's a contract that's liquid that represents exactly what you're trying to achieve available. There are many other scenarios where you can't, there aren't, and you're having to use proxies and substitutes and approximations for that hedge. Can you give us a specific example around that and kind of talk us through the thinking and why this is perhaps when you start needing experts and traders in to actually do this correctly?
Yeah, sure. So as you mentioned, on base metals, we are very fortunate in the fact that we have these highly liquid, perfectly correlated exchanges. Although I would say even within base metals, you look at the lot sizes of futures contracts, there is still going to be some basis risk between the exact tonnage of your futures trade versus the exact tonnage of your physical. But we assume a perfect hedge as closely as we can get. And then there's these other commodities whereby there either isn't an exchange at all, or there's not a liquid enough exchange, or the commodity is not 100% correlated with the actual commodity that's being traded on the futures exchange. And those traders, those companies, do have a gap that needs to be filled. They may either just go outright long or short. They may try to what's known as back to back those purchases and sales. So they kind of eliminate that price risk with their physical at the same time. But it's a struggle sometimes to try and hedge when the market is not available to you for that product, or there's not a direct correlation or 100% correlation between that commodity. You may be trading something that there is a liquid exchange, but the grade or the shape of the commodity you're trading means that it's not a great correlation to the futures market. So in that respect, even though an exchange is available to hedge on, it may not be the best fit for your specific commodity that you're trading.
The energy and resources sector is experiencing unprecedented change. To help companies navigate this world and capture its opportunities, HC Group launched Enco Insights in 2023. Enco has rapidly become the leading global expert network dedicated to energy and resources. Enco Insights leverages HC Group's 20 years of connections and dedication to the sector to give clients the expertise they need to take decisions fast. Connect with Enco's experts for anything from a 1-hour insight call to a longer-term consulting project at encoinsights.com.
I guess this is a moment to pause here as well, which is this is getting increasingly complex, though, in the sense that we're starting to talk about attributes, talking metals, right? Green steel or carbon content for the upcoming CBAM. That I guess that's going to cause a proliferation of new contracts, but they might be very illiquid, or actually we're going back into a world where we try and decommoditize. Things start to get more difficult to hedge and therefore more volatile again.
Yeah, I think with the way that the exchanges are going, they are managing it fairly well. I don't honestly think that it's going to get so granular that it becomes unmanageable. I think they are going to, stick with the most widely traded if they do expand. Whether that is a green element to hedging or a grade or quality, I do think that they will probably try and stick to the most widely traded of those commodities, even when they do start to break it down.
Right. Okay, great. And so then the other big cost to this and risk is margin calls. Before we
Yes.
talk about sort of the dynamics there and some of the risks and some of the recent historical examples around, for example, nickel and so forth, can you just help us understand what a margin call is, who requires it, and how the actual operations go there?
Yeah, absolutely. So, to trade on the exchange, there's two types of margin. One is initial margin, which is essentially a down payment that the exchange requires that helps offset any default risk, which is usually a percentage or a fixed amount of the value of the futures commodity that you're trading. and essentially is held by the broker until that trade is settled. The other type of margin is variation margin, and variation margin is essentially a running mark to market of the value of your executed trade. So if, for example, you've bought a copper futures contract at $10,000 a ton, and the next day the price of copper for that same prompt date goes to $10,500 a ton, then your long futures at 10,000, and that trade will hold a positive margin of $500 a ton. If the price goes the other way and your long futures, if the price decreases and now it's $9,500 a ton, that trade will carry a negative margin, negative variation margin of $500 a ton. So variation margin will be collated between the entirety of your trading book, all of your futures trades, and it will be valued on a daily basis against the current market. And once you breach a certain limit, if you have a credit limit, or just if you don't have a credit limit, once those trades are deemed out of the money versus the current market, you will be required to finance that difference in cash to cover the broker in case of a default, and they had to close out those open trades. They will hold that cash, and that will exchange back and forth between broker and the hedger, basically for the life of that trade until it's squared or until it settles.
Firstly, I just want to talk about initial margin. What's been going on there? Have those been increasing in the wake of sort of the recent volatilities? How's that going?
Yes, so very recently on the LME, for example, they just increased the initial margin for copper, I believe zinc and lead. With the increased volatility, with the run up in prices, typically as these prices increase, the exchanges will require a larger amount of cash to be put down for each one of those futures traders. Now, they're relatively quick to adapt to these changing prices, but as you mentioned, as volatility increases, the likelihood of the initial margin amount changing will increase as well.
Yeah, and working capital is so critical to businesses, particularly in the commodities sector where it is low margin and the price of cash has gone up. Has that put any kind of dampener on, we talked earlier about organizations that really should be hedging. And I just think about my own company, our FX and so forth. But, that is a significant concern now about the price of that working capital and how much gets tied up as you increase initial margins on these hedges.
Yes, certainly. And as you say, with a higher interest rate environment, certainly the cost of that capital does increase. Now, a lot of brokers will offer credit lines for those reputable companies who do wish to hedge on the exchange. So that is how a lot of companies will handle their initial margin financing through credit lines with the brokers. Obviously, they are essentially loans, so you are going to pay an interest on those, but that interest is much more advantageous to pay than outlaying the actual cash to finance those trades.
Yeah, we had Jack Farchi on this time last year talking about the nickel crisis in detail, and I didn't invite listeners to go check it out. It's a good one. Obviously, this is a point of existential risk if you get such phenomenal price spikes, or the other way, that actually your margin position can suddenly become an exposure for your organization because you can't meet those requirements. That was very much, just talking the metals market, apparent in the nickel space. It's happened in other commodities as well, particularly some LNG cargoes and so forth. This is, again, it's kind of like, it's hedging should be doing it. It's simple. It's now more democratized than it's ever been, but it can also be a source of significant risk. Can you just give us some sense of when these things have gone wrong?
Yeah, sure. I mean, as you say, it is a risk. I would argue that the risk of that is less than the outright risk of prices moving against you, but certainly something to consider. And especially for traders and those who are inherently long physical product, it means they are also inherently short futures. So in those environments where you are likely to get rapid price increases, you can find those short hedges, those short futures positions becoming rapidly out of the money and moving far in advance of any credit line that someone's willing to afford you. And those positions have to be financed in cash the following day. So part of hedging is definitely managing your cash positions, making sure you are well financed, and making sure that you have the facilities available to manage those hedges, be it through pricing physical sales early, and really just staying on top of that management of those hedges to make sure that you can at least forward plan for these situations. Obviously, the nickel kind of black swan event where it tripled in price within the space of 48 hours. I don't know if there's any amount of forward planning that you can do for that, but having those systems in place where you are looking forward and managing your hedges proactively is certainly part of having a hedging program in place.
Out of interest, what would have happened if said trading house couldn't meet margin calls the next day? What happens to those trades on the exchanges, and what happens to the organization?
I mean, it would be disastrous. Depending on the exact situation, you would get liquidation proceedings happening very quickly. The brokers would start closing out those trades, so you'd no longer have that protection. Your credit as a company would be shot, so trying to trade in the future would become very difficult. So yeah, I mean, it's missing a margin call payment is not something you ever want to be in the position of doing.
No, and I guess what happens is it actually forces you to start selling your physical at a premium, right? Making profits there, but not as much as you could be making if you're
Exactly.
doing a fire sale.
Yeah.
Before we talk about the book, let's talk about the future of this. So obviously one area is we can see that we are more organizations exposed to commodity value chains are going to be hedging to a greater or lesser degree. There's a challenge there about how do you gain that knowledge, how do you gain that trust, how do you get the people. But this is also presumably an area, if I think about the other skeins of sort of what's going on in the sector, one large piece is technology. And just sort of interested to get your take on how much technology can now do the heavy lifting of actually designing and then validating hedges and automating some of the post-execution operations.
Yeah, absolutely. I mean, with the advent of AI, artificial intelligence, there certainly may be a point where there are offerings either directly from brokers or, independent software that can tie directly into a company's order books that will reduce the need for as many kind of dedicated employees that are managing those hedging books. But I believe that in order to take full advantage of all of the opportunities that hedging offers to companies, you're always going to need some kind of human element to be involved in that execution, who needs to be well trained and looking to capitalize on those opportunities as and when they see them that a software may not be able to correctly identify. Hedging is very nuanced when it comes to some of the aspects. And so I think that companies will be hesitant to fully give away that to a computer program.
Is this sort of the gateway drug to actually become trading, right? If you are a producer and you start, and we're seeing this in the market, right? You identify the need for a hedging program, you start to put people in place for that. Is this sort of naturally then progresses to actually we can start taking speculative positions based on the knowledge that we have in? I mean, how is it that dynamic, or will
I
most organizations most of the time remain? We just need a hedging program.
Yeah, I think for the most part, yeah, I certainly wouldn't call it a gateway drug, but I think that most companies involved in hedging have very clearly defined parameters on exactly what that hedging program is looking to achieve, who is allowed to do that, and what the scope of that is for them. There are some companies that maybe having had a hedging program for a number of years will say to themselves, maybe let's take a little bit of risk. we will hedge 90% of what we can and we'll leave 10% open, or we will maybe employ one person who can take some speculative positions. But for the most part, I think that that's an entirely separate conversation when you make that jump from hedging price exposure to now we are trying to take additional risk on those prices.
Yeah, it's a very different group, right? Typically, what
Yeah.
we're talking about here sits with the CFO, and frankly, they probably have an FX hedging program, probably provided by a third party. But most international corporations have that. This is actually starting just to extend that out to some of the key commodities that they're exposed to. But as you say, and the reason for the book is that there seems to be quite a gap, or at least there's been sort of an attrition of those kind of functions in that period of low volatility. Well, let's turn to the book, which I have to say I enjoyed. It's nice and clear and simple for the likes of me. But why write it, and how big is the gap in the market you saw for this kind of lack of knowledge for it?
Yeah, I mean, I've been teaching this as part of my various roles for the best part of the decade, and kind of always thought to myself, I wish there was a book that I could either give to people or help use to explain some of these concepts, and there really just wasn't one that I could find. So I decided to take it upon myself to write it. The feedback's been really great, and as you mentioned, it really does take these concepts that are too often viewed as complex and misunderstood and breaks it down in a really practical way with examples that can be drawn upon and utilized in these day-to-day jobs. It's very practical. It's not theory based like a textbook. So you really will be able to directly apply this knowledge to your role.
And how is it, in terms of the sort of the consulting that goes alongside this book, and the book is sort of the emblematic of that. Like, what's the reception like out there? Are you seeing an urgency from non-traditional players or just people within that supply chain recognizing this need? Has it fallen on soft ears, or is this still sort of it's not voodoo? What's the reception been?
So far, it's been really, really great. Across the spectrum, I was a little bit surprised by the diverse range of people that I've been working with, but from banks, miners, producers, traders themselves, and consumers. I think as we enter this period of very high volatility, I think it's twofold, right? It's one, we don't want to be exposed to this risk that we can mitigate, but also we want to be able to take advantage of some of the opportunities that hedging allows us. And so we want to have our staff well trained. We want to, have those processes in place where we're not being reactive, we're being proactive. And so the reception has been really great so far across the board.
Well, I'll put links to the book in the show notes, and I do think, again, I kind of was racking my brain thinking, have I, where else have I seen books that are just dedicated to this, and I haven't. And I think it is going to be an important book, particularly as as more and more people need to be attracted to and drawn to the sector, which is, let's face it, talent light and has been underinvested in from a talent perspective over the last 15 years. And suddenly now we're right back in volatile times, and there's going to be a lot of individuals that are needed, and also a lot of people sat in these various functions within finance and treasury that just need to now have this skill set. So I applaud you writing it. But of course, thank you for coming on.
I really appreciate it, Paul. Thank you for having me.
Thank you for listening. To find out more about HC Group, our global offices, and our expertise in search within the commodities sector, please visit www.hcgroup.global.